Do you see the location of assets influencing sustainability and innovation strategy? So I'll maybe give a specific example, right? Would the fact that you have a lot of gas-based crackers here in the US versus liquids-based crackers, say in the Kingdom or in other parts of the world, does that preclude you from the ability to use, let's say, pie oil as a feedstock going into these crackers? I know that some of your new technology development is focused on addressing some of those gaps, but I wonder if there is a difference in terms of what your strategy is.
Yeah, that's a great question. So look, I think there are technology solutions for managing plastic waste, either with gas crackers or liquid crackers. But I do think that pie oil integration and liquid crackers, as well as refinery integration, which I didn't talk about here, but I would say, I think refinery integration and those companies that have an ability to be upstream integrated have an immense advantage on managing the plastic. So we're very engaged in work in the Kingdom, which has been announced in terms of refinery integration, as well as with Motiva, where we're evaluating that here in the US, as well as integrating pie oil into our liquid crackers. I think when you start looking at the gas crackers and how you integrate, you have to look at things like gasification as a way to get to maybe feeds that you could use, or the technology got highlighted, Angevok. That's a technology that allows liquid feed into a gas cracker or a gas furnace, let's say, and that's the whole mindset behind that, which is either feeding pie oil or feeding heavy liquid fractions from the Kingdom and being able to co-crack more efficiently. So I do think you're going to see a need for evolution of new technologies, but I also think that, again, I think the ability to refinery integrate has advantage.
Yeah. So, you talked a little bit about how innovation is slowing down. I think the chart that you had that we couldn't show because of the animation was how the number of new material discoveries has fallen over time.
Yep.
But at the same time, you end the presentation talking a little bit about how you have taken a series of small steps towards, let's say, commercializing pie oil-derived recycled plastics. The time scales are also very different, right? There was a lot more appetite, a lot more investor interest, I guess, in innovation 50 years ago than there is today in, let's say, going and announcing a massive innovation initiative. So I guess, how do you balance that, and what's the right approach?
I think it's a great question. Look, I think first off, the economics have changed a bit in the sense that, where we would say, look, we're not going to implement a solution because it delivered only a 10 to 20% capex improvement, especially if you would take CO2 into account and the energy costs into account. I think some of those economic cases are going to change, because I think if you can address the broader issue, and like our company and many others are pricing carbon into the capex projects, I think that will have an impact to a certain extent. But I think the mindset I think we have to get into, and I think has been successful here and with our peers too, is I think taking capex investments on real models of getting things into the market and validating the economics. So I'll take the pie oil example. If I had to go justify a billion pound per year, production of pie oil derived plastic products, it would be tough for me to do, to justify building the pie oil facilities, the number of them at the scale that they're at today, maybe hydrotreating those and then doing, full cracking of that. But I could get material into the cracker. I could validate the economics of the value from those products. I could understand the operability of it. I could then make the investment in the next scale of capex, knowing that I understand the market space. And same with the decarbonization piece. Like, can I make the argument today that I'm going to go displace our cracker in Helene with all E furnaces? No, it would be a hard justification to make. But I can commit to spend the capex to replace a furnace with a new technology and do it in a way that demonstrates and de-risks it. So I think we have to get comfortable with taking those steps, which means disrupting our asset footprints, and that's what we've been, scared to do in the past, but doing them in the right logical step of scale, because the technologies are also evolving while we're taking these capital risks. So like pie oil to me is a great example. what technology should I use to go convert plastic to pile at 200, 300, 400 kiloton scale? I think we could debate for hours whose technology is the better one, which one should we use? That's the wrong debate. I mean, the debate needs to be, how do I get a larger volume into my crackers at a level that I can justify the economics? And in 5 to 10 years, it'll be clear what technology solution is the right one, but I can't wait for that today. So it's about taking measured risks now, and being comfortable taking that CapEx risk. Even on the pricing on circular plastics or the pricing on low carbon solutions, the best way to truly validate the assumptions on what value you can get is to take the product to market and validate that. And you don't have to take it to market at a billion pound scale. You can take it to market in steps. So it's about approaching it differently and recognizing that I think for the next 5 to 10 years, we don't have all the answers right now. But if you wait to 2030 to sort of wait for the optimized set of solutions, I think your position in the marketplace will be too far gone.
Yeah. I mean, that's an interesting point, right? I think what you're saying is that we went through this phase where there was tremendous support for innovation. Let's go develop a bunch of new materials. Then we commercialized it. Then we got into this phase where I guess R&D organizations kept working, but the assets would just not, there'd be a lot of resistance in commercializing those technologies because they just don't want to mess up their operations. And I think that it seems like some of those bottlenecks are getting resolved, or we need to take a different approach.
Yeah, I mean, I think at the end, when a business isn't growing, it's very tough to implement anything new, right? Because you don't build new assets and you don't displace them. And I don't want to pick on any businesses here, but I mean, for those that have been engaged, that were engaged with the DuPont ethylene copolymer business when DuPont owned that business, I mean, they weren't growing the business, and so because they weren't growing, they optimized the portfolio. This is a classic way this works, right? You optimize the portfolio for value, and you keep raising the margin average up, which they did. And then you focus on, and then all of a sudden you get to a point where the asset average is so high in value that a new product doesn't make enough money to compete in that mix anymore. So then you don't need as much R&D, and you focus on application development. And then you leverage that to continually drive value and share in the marketplace, and it works extremely well. This model is very effective until a point where you're not launching any new products and the value is well understood by customers, so you start questioning why you need as much application development. So then you start cutting there. And then you end up in a portfolio that's extremely high value, that's not supported by a lot of resources anymore, and is in a very large share of the marketplace. With a desire for other materials to displace those materials. And that's a classic commodity. You could take that in, when I was in Dow in the cellulosic business, a similar sort of challenge happened. This happens in most portfolios. If you're not growing, you have this. Now the question is, when you're growing, how comfortable are you putting a new technology into an asset? And where companies like Dow and BASF and others have been extraordinary is at least when they're growing, and I'll take polyolefins as an example, being willing to take an improved process design into the next asset. Companies that can do that and being willing in the growth to take a risk on an improvement and or a disruptive approach are going to succeed. But it's extremely challenging because you are competing against a very tight margin set of something that's very de-risked, it's very low cost. But my concern will be, and I'll take the plastic question, and this is the thing that always keeps me up at night, is if I'm a brand owner who wants to convert to a new solution for packaging that has a lower footprint or is more recyclable or is bio-based, whatever the solution is. The big argument for us in the past against a displacement with a bio-based material or some other solution is, well, look, we have the lowest cost position, a fully capitalized footprint of solutions to provide you in the market, those solutions. You'll never be able to compete and deliver that solution. And it was very effective. We have a great barrier to entry because of the scale and integration that we provide. The moment, though, that you have to deliver a decarbonized set of solutions, and these brands are now saying, I have to deliver a new set of solutions to decarbonize, the moment I say, well, I'll do it for you, but I've got to invest a lot of CapEx to manage pie oil, to manage this, that, or the other, to do carbon capture, to do electrification, and I need you to help me pay for that. Many are willing to do that, but they're now that you're asking them to spend more, the question, and that barrier to entry becomes a little bit less strong. because they could choose to spend with you what's needed to go deliver that transition, or they could invest with something else. So I think that if there's a fear I have, it's this, which is, if we've always believed that it was an impenetrable sort of ecosystem because of the costs and efficiency. But if you have to disrupt it, it's a choice for investors of whether to put money in you to do that or to put the money in someone else to do it. And there is now a threat more than ever that investors are looking and saying, I'm not confident of where to put that money, and I may decide to put it in different places. And that's how you get disrupted. And it won't be disrupted because somebody takes your business all at once. It's going to be disrupted because somebody builds a new plant to develop a new product that is lower footprint and more circular perhaps. And that one plant gets traction in the market and allows more investment. And this won't happen overnight, but it'll happen in a series of small cuts that will really disrupt the industry.
You made an offhand comment about how you debate with your colleagues at Aramco on what is the outlook for electric vehicles and all of that stuff. Do chemical companies, because of I guess they're further downstream, probably talk to the auto guys more than the guys producing the fuels? Do they have a better feel for where the EV market is headed?
No, I think that it's just the lens of perspective that you look from. I think that for sure, I think we understand better how fast the transition will happen in EV. Mm-hmm. But I think they also have a better lens on the volume growth of liquids that's still going to happen in geographies that are going to transition as fast, right? And I think that at the end of the day, the amount of oil that's still going to be needed through this transition still requires more production over the coming decades. So it's a question of subtleties of assumptions on growth in emerging geographies, how fast those transitions will happen. It's not a question of really, will Europe transition or not, right? And what impact that has. It's more a question of the overall demand. And I think, at the end, everyone knows that transportation fuels is a market that they'll be shifted. Mm-hmm. It's why the kingdom is committed to moving from 1 million barrels into chemicals to 4. Yeah. And I just make that reference. I mean, and this is public, but we're talking about putting additional 3 to 4 million barrels of liquids into chemicals by 2030. So just think about the volume of products that is. So there's a recognition that that's being disrupted and that's going to transition. But you can debate the timing, right? And you can debate, the relevance of all those transitions. I think we certainly, to that point, have a lens on our customers and the applications and in the mature geographies how fast that. Probably better than they do. Mm-hmm. But I think they have a pretty good understanding of the global demand for oil and how maybe from a mature market perspective, we overlook what might